mortgage rates aren't going to be dropping to the 3 to 4% range anytime soon. So when I threw up Lawrence Yuen's post on my story, the natural question people had was, if mortgage rates were at 18% at one point and they got down to 3% in the future, why couldn't that happen again? When you hear economists speak about their predictions of what's to come, economists generally talk in what's called the short run, meaning the next 3, 4, 5 years, depending on the type of markets that they're speaking about. So while a 2 to 3% mortgage rate is of course possible in the future, based on the current market fundamentals that I'm going to show you, it's looking pretty close to impossible for mortgage rates to hit 2 to 3% over the next 3, 4, even 5 years. Before we get started on why mortgage rates aren't dropping to 2 to 3% anytime soon, let's make sure we have a good understanding of what causes mortgage rates to go up and down. Despite what most people think, the 30-year fixed rate mortgage actually follows the yield of something called the 10-year Treasury bond, which means mortgage rates are not directly impacted by what the Fed is doing with the federal funds rate, which is what most people think about when they hear interest rates. So a better question to ask isn't what drives mortgage rates. It's more, what is a bond and what drives the bond yields that affects the mortgage rates? So here's what a bond is. A bond is basically like an IOU, or you can think about it as a loan. Somebody needs to raise money and they're saying, I will pay you back a certain percentage of what you're investing into whatever cause I'm raising funds for, and I will pay you back at a certain date. Here's what that would look like if you were buying, say, a 10-year Treasury bond. Let's say the price is $100 and the yield that it's paying out, and the yield is just another way to think of it is interest rate, since most people are familiar with interest rates, of 4%. So you're gonna get a 4% annual yield in exchange for you buying a certain amount of bonds from that person. In this case, you're buying bonds from the US government, which is considered the safest type of investment because the US government has never defaulted on its debt ever. And so in this case, for investing in the US government's bonds, they're gonna go ahead and pay you a 4% return, which after 10 years, you're gonna get back $14,859.47. Now, the yield is paid out every 6 months, so it won't be at the end, but that would essentially be what your $10,000 return into after earning 4% per year. And so if a US bond is considered safe, what would be some assets that are not considered safe? Here's a couple for you to take a look at. The reason why mortgage rates follow the 10-year yield is because mortgage bonds, which are backed by mortgages, are considered one of the most safest assets you can invest in after US Treasuries. In order to get investors to invest in mortgage bonds, the mortgage market has to charge higher interest rates to be able to pay investors higher returns so that they're enticed to invest in mortgage bonds instead of 10-year Treasuries. So basically, a mortgage bond is a little bit more risky than a US Treasury, and so to account for that added risk, there's something called a spread, and that's where mortgage rates come from. So in order for mortgage rates to go down, you would need a 10-year Treasury to go down ahead of time so that mortgage rates could follow. So when does the interest rate on the 10-year yield fall? For that to happen, you need the price of the bond to go up, which would cause the yield to go down. And the opposite is true. If the price of the bond goes up, then the yield goes down. So in that case, you'd want 10-year US bonds to go up in price so that the yield goes down, which would then cause mortgage rates to also go down. And the 10-year Treasury is like every other market. It's all controlled by supply and demand. The more people that buy Treasuries, the higher the price goes and the lower the yield. The opposite is true. When a lot of people are selling these Treasuries to move their money into real estate, stock, crypto, that causes the price to go down and the yield to go up. Why does that happen? Well, if you want people to buy bonds and the return on the price of those bonds is low, meaning the value of those bonds is going up very slowly, then you need to pay a higher yield or interest rate to get people to invest in the bonds because you're trying to generate cash, which is generated when people buy the bonds. And finally, here's why mortgage rates aren't going down to 3 to 4% anytime soon. Let's take a look. So here on my screen, I've got a couple different charts pulled up. So this is the average 30-year fixed rate mortgage in the US. the yield on the 10-year Treasury bond, total amount of treasuries held by the Federal Reserve, and then the federal budget. If we take a look at the 30-year fixed rate mortgage, here's what my follower on Instagram was referring to. Hey, at some point we're at 13%. Why can't we get back down to 2 to 3% in the future? So let's take a look at this time period right before the recession of '08. And let's start Q3 2007, and we'll take that to, let's do 2015. This gray bar represents a recession. So on the chart where you see all the gray bars, those were recessions. But in the past, I mentioned that during typical recessions, the home price values typically go up. And that's usually due to the fact that interest rates normally go down. And let me show you why. This was the crash of '08, where the US government had to print trillions of dollars to bail out all the companies that were failing. So you'll see the fixed rate mortgage went from, prior to the beginning of the recession, 6.55, dropped about 0.75%, rose, and then completely plummeted to low 5% range. So let's take a look at the yield and see what happened here. You see the 10-year Treasury yield, huge drop. And so you see here that the 10-year Treasury at this dip was 2.74 versus 5.06. So the difference between the 10-year Treasury and the average mortgage rate, that's the spread I was referring to. So that's how much more mortgage bonds are trying to pay investors so that they can buy mortgage bonds, which banks then use the fund that they got from the bond sale to then make more mortgage loans. You'll see it referred to as liquidity. Now I'm going to take a look at the Fed's Treasury holdings, basically how much US Treasuries the Federal Reserve was holding prior to the recession, during the recession, and we'll look at a COVID recession next. So you'll see prior to the recession, the Fed was holding about $750 billion in treasuries. Then the bailout for the companies that were affected during a recession was announced, and the Federal Reserve started buying treasuries. So if you see the line going up, this is how many treasuries the Federal Reserve is holding. This means as they're buying treasuries in the market, their holdings is going up. That's how much they have stashed. If you remember from the beginning of the video, the more treasuries that are being bought, the higher the price goes up, the lower the yield goes down, which helps mortgage rates go down. So you'll see a huge spike in treasuries that the Federal Reserve was holding in Q3 2011. They basically quadrupled the number of treasuries that they had, from 474 billion to 1.6 trillion. And I'll explain to you in a second why the Fed buys treasuries. But let's take a look first. Q3 2011, huge spike in treasury holdings that the Fed had. Q3 2011, let's see what happened to yields. Q3 2011, you start to see this massive drops in yields. So by Q3 2011, the yield was 2.41 for US Treasuries, 4.29% interest rate for the 30-year fixed mortgage in Q3 2011. So prior to the recession, Q3 2007, mortgage rates were 6.55 versus 4.85. So almost a 2% drop in mortgage rates following the recession due to the number of treasuries that the Fed was buying during this recession. And so you'll see from basically 2011 to 2012, the Fed didn't really buy much in terms of treasuries. They actually sold off some treasuries, or let them expire, I should say. Okay, so Q4 2012. Now let's take a look at everybody's favorite time period, the COVID pandemic, and see what happened there and what we're dealing with today because of the pandemic. So here we see mortgage rates were floating around 4%, low threes. We hit low threes a couple times, but generally floating between 4 and 5%. Mortgage rates started going down prior to that pandemic. This is inflation. This is the data that the Fed is looking at for inflation. Inflation was really low. Inflation was going down to down to 1.3% prior to the pandemic. So because inflation was so low, because if inflation is low, banks want to make more mortgage loans at lower rates because they'll still make money on a 3% mortgage if inflation is only 1.6%. And so how did we get to sub 3% mortgage rates during the pandemic? Well, if you guys remember, the economy was completely shut down. And so the government had to pump tons of money into the economy. We were talking about stimulus checks. We're talking about PPP loans. At the same time, we had Trump's tax breaks kicking in. And so that was a ton of money that the government had to come up with. And so how does the government come up with money to spend on student loan forgiveness, to spend on PPP loans, to give you tax breaks? Well, in order for the government to spend money, they need to have money. And where the government gets money from is from your income taxes. So what happens if the government spends more money than they're bringing in income taxes? That is what's called a deficit. So when we have a deficit, what the government does is they sell Treasury bonds to get money from investors to then go fund those PPP loans, those student loan forgiveness, the federal tax breaks, because if you give a tax break to people, that means the government is bringing in even less money, which means they have to sell even more treasuries. And what happens when a lot of something is being sold? The price of that thing goes down. So in this case, we see that, oh shit, we need to fund a crap load of stuff. The government does. So what did the Fed start doing? So the Fed started buying a shitload of treasuries so that the government can spend money. So take a look at this increase. $2 trillion in treasuries that the Fed was holding in 2019. They doubled the amount of treasuries that they had in just 1 year. But it didn't stop there. The Federal Reserve basically 4x the amount of treasuries that they were holding, which caused treasury prices to go up and the yields to go down, which you see here in the chart. You see the yield on a 10-year treasury plummet to basically zero. So it means if you bought a treasury, it was like paying you nothing. It was like having your money in a savings account. So there was no reason to buy treasuries because the Fed was buying them all and causing the yield to go super low on them. The only parties that were buying treasuries at this point, because who's going to park their money for 0%? Which then, if we look at mortgage rates, you see mortgage rates pretty much rock bottomed after the 10-year treasury. 10-year treasury dropped first, mortgage rates followed after. Look at the gray bar for a point of reference. 10-year treasury hit rock bottom first, then mortgage rates hit rock bottom. So then why did mortgage rates take a huge spike? Well, the obvious answer is 10-year treasuries took a huge spike. But why did 10-year treasuries take a huge spike? Well, something called inflation took a massive peak. Basically, inflation went to the highest level since the 80s. So what did the Fed start doing? They started draining money out of the economy. So this is the treasuries that the Fed has. You can see it's starting to decrease. They started selling off these treasuries, which again, if you sell, price goes down, interest goes up. So they're selling, trying to pull the money out of the economy to avoid inflation spiking to crazy levels that we saw in the 80s. And it started having an effect, right? We start seeing inflation starting to drop. If I change this graph to monthly, let's go 10 years, you can see inflation started taking a huge dip in 2023 because the Fed was draining money from the economy by selling treasuries, which caused the price to go down and the yield on the 10-year treasury to go up in 2023, which of course mortgage rates followed. So here's your answer on why we're not going to see 3 to 4% mortgage rates anytime soon. 2 reasons. First reason is the Fed still has a shitload of treasuries that they need to get rid of before we get anywhere close to whatever the long run average is that they've been holding. So, from even when rates were in the fours, the Fed is still holding twice as many treasuries as they were back then. And they want to offload these treasuries so that they can continue to bring inflation down and keep it low. So they're going to continue selling off and letting these bonds expire. And the second thing is our federal budget. So what this represents is if you had a budget that was, you have $100 coming in and you spend $100, you're balanced. You don't owe money and you're not saving money. If you have a budget of $100 and you spend $200, well, now you're $100 in debt. Does that make sense? And you probably pull that $100 from a loan or a credit card or some other way to get you borrow the money. So you'll see anytime this blue line goes below zero under that black line, this means that we were in a deficit, means the US government was spending more money than they were bringing in tax revenues, okay? And the way this got funded was by selling US Treasury IOUs, AKA loans, that the government now has to pay interest on in order to fund whatever the government was spending at that time. The last time the US government was bringing in more tax revenue than they were spending was under the Clinton administration back in 2000. We have been in a deficit or overspending how much our government is bringing in revenue for the last 25 years. So the lower this goes, the more the government is borrowing, the more US treasuries that they're selling to be able to fund this. So obvious reasons, there was massive bailouts during the housing crash of 2008. Tons of money had to get spent that we didn't have. Slowly but surely, starting to get closer to being balanced, and then the pandemic hit. And trillions of dollars were printed out thin air using US treasuries. So look at the trend. The government is still spending massive amount of money that we don't have. So in order for the government to continue to spend money that we don't got, the Fed's gonna need to continue to sell treasuries to raise that money. Like, the treasuries don't already exist. What they do is they create new treasuries out of thin air, increase the supply, which tanks the price and increases the yield, which increases mortgage rates. It's the same concept of if you have 10 homes on the market and 100 buyers, it's a super seller's market. Prices are going up because you have way more buyers than sellers. But if you have 100 homes that pop up and there's only 10 people willing to buy a home, you're gonna have massive price crashes like you had in 2008 because there's not enough people to support the prices. And so sellers have to continue to lower the price until people buy their homes if they really need to sell it. It's the same thing with the bonds. The more of them that there are to sell, the lower the price that they have to go, which means in order for them to get bought to fund the government spending, and that means that the yield on the 10-year treasury goes up, which means mortgage rates go up. So if I were to guess, it might even be possible that we see mortgage rates actually go up unless we see a recession. And so that's the reason why mortgage rates aren't going down to 3 to 4% anytime soon. The government is borrowing too much money for rates to naturally go down that low. And the Fed still holds a shitload of treasuries that they have to unload by either selling or letting it expire. Regular investors, when they buy treasuries at the end of the 10 years, they use that money that they get back to go buy more treasuries or other investments. The Fed, when their treasuries expire, that money just gets destroyed. It's gone. They get whatever money, say $1 trillion, and say it expires and now it's back in their bank account, they just delete it from their bank account. So that money's gone from the economy forever. So it looks like we're gonna have elevated mortgage rates for a while. Let me know what questions you guys have in the comments. I would appreciate if you guys follow me on Instagram and subscribe to my page. I'm getting ready to ramp up some more content for you guys in the new year after the holidays, after I get some skiing in. Appreciate you guys watching, and let me know what questions I can answer for you guys.